Hi there everyone, it is Monday the 30th of October, and that means it's time to take a look at what moved the markets last week. We saw a dramatic fall in asset prices, well specifically equity prices, last week, and both the NASDAQ and SP500 fell into correction territory. A correction is typically seen as a fall of between 10 and 19% from the most recent high. There is quite a lot of fear out there at the moment, and sometimes that's not the worst thing. We can see that this is reinforced by the fact that the price of gold has had quite a run-up in the past few weeks, rising 10%. This is a huge jump in the price of gold. The price of gold tends to move fairly slowly. And gold is of course considered a safe haven, probably the best known safe haven. Although if you look at its very long-term performance, you can see that it's usually not a great idea to rush into gold. It hasn't done very well over the past decade plus. While we're on the topic of commodities, we can also see that the price of oil has been jumping around but seems to have more or less found a local bottom. And the thing driving the price of oil at the moment, well, there are many factors, but one of the major factors is the war in Israel/Palestine. The reason that is a big factor in the price of oil at the moment is that there could be a constraint in the supply if other Middle Eastern countries get involved in the conflict. A high price of oil is bad for all kinds of reasons, one of those being that it is a large input to the rate of inflation because so much of what we produce in terms of energy depends on oil, but also there are lots of things that are made from oil. I know that we usually look at the major indices within the US, but I did also want to point out another of the indices, the Russell 2000. And the reason that I wanted to point this out is that it's good to understand how companies of different sizes are performing at a certain point in time. It gives you an idea of where investors' heads are at. The NASDAQ 100 and the SP500 are indices that contain very large companies. And although there has been some volatility in those indices, people tend to prefer large companies in troubling times because they have deeper pockets. However, you can clearly see here, the Russell 2000 is 2,000 smaller cap companies in the US. You can see that the index price has fallen from its high at the end of July by 18.2%, so nearly double what the other major indices have fallen by. This tells us a few things. Obviously, investors are shunning smaller companies because they're worried about the potential for these companies to default. But it also means that there are a lot more opportunities within this lot. There are still some very large companies that, despite the fall in share prices recently, are quite expensive. We all know about the strong recovery, for example, in the NASDAQ 100. But if you go back through recent history, you can see that this index, these companies, these smaller 2,000 companies, their collective share prices really haven't recovered. And in fact, this index's price is back to where it was around 2020. So for those of you that are bargain hunting and have an appetite for volatility, because these companies tend to be more volatile, then you might want to use the lens of the Russell 2000 to start looking for those opportunities. I also like to look at the fear and greed index from time to time. I don't think we need to look here to know that the market is in a position of extreme fear. But what is interesting about this is that whenever the market finds itself at extreme positions, whether it's greed or fear, these are usually fairly good contrarian indicators. They don't work out every time, nothing is certain, but quite often they tell us that the market has overdone it in one direction or the other. So what were some of the key drivers of that crazy market action that we saw last week? Well, one of these would have been the powerful GDP growth rate that the US put out. So we can see that it came in at 4.9% last week. And this is mind-boggling. It not only beat expectations, you can see that the expectation was for a growth rate of 4.3%, still very strong, but you can also see that it's comparable to this period after the coronavirus crash when the US government was pumping money into the economy and literally handing it over to citizens. The country now is in a very different place. The Federal Reserve is pulling money out of the market in several different ways, including interest rate hikes, but also through quantitative tightening. And if you drilled into the numbers that were delivered last week, and I did, it shows that the US consumer was a very large component in driving the growth number that was delivered. This is a bit of a head scratcher given the other data points that we have about the US consumer being tapped out and also the rise in defaults on loans. I am still quite cautious about how far the US consumer could stretch. Just because the US has had this blowout GDP growth doesn't mean that that's going to continue through the next few quarters. So we're still getting a fairly mixed picture. The market is obviously not very happy and hasn't been through the past few weeks, but we do need to look forwards to see how the market might respond over the next few quarters/years. Right now, the US labor market is still quite strong. GDP growth has obviously been strong in the most recent quarter. And another piece of information that we got last week was around the Fed's favorite measure of inflation. And we can see that it came in bang on in terms of expectations. And even more importantly than that, it continues to decline. It's been a fairly slow decline, but it is declining. So the situation that we find ourselves in right now is that interest rates are high. Inflation is fairly high, but falling. Economic growth somehow is stronger than just about anyone expected, as is the labor market in many developed nations. It's certainly not hunky-dory out there. It's a bit of a mixed picture, but it seems to be leaning towards the midterm future being fairly good. Right now, it seems likely that inflation continues to fall, and at the same time, countries that have ratcheted up the interest rate so aggressively through the past few years might start to bring them back down, albeit at a fairly slow pace, but bring them down. We're also in peak earnings season, and so that continues to be a driver of the market. Last week, we saw a number of major companies report earnings. These aren't just the companies that I own. There are also a list of other popular companies on eToro in this list. And once again, it was a mixed bag. There were some earnings reports that weren't very good. There were some that were fantastic. Microsoft did incredibly well. Amazon did incredibly well. There were those that were quite good, but they had soft pockets within their businesses. Google, as one example, its cloud division isn't doing as well as people had hoped. Meta was doing quite well after hours until it mentioned that it expects softness in the advertising market in the coming year. And then we heard from the likes of VW. Automakers are incredibly correlated with the economic cycle. And although they forecast profitability for the year, they said that there is softness in automobile sales, which we're hearing from just about every automaker out there, including Tesla. So far through earnings season, this has been the pattern. It's not all bad. It's not all good. There are some companies that are doing fantastically, others that are doing less well than hoped. And this mixed bag of numbers that we're receiving is actually a lot better than people had expected 6 months, 12 months ago. While we're on the topic of earnings, I do want to put out one or two very short earnings review videos later this week. Amazon is a very interesting company for a number of reasons. You can see that their capital expenditure, for example, ramped up enormously through 2019 and 2020. It topped out in 2021, dealing with all of that demand pulled forward because people were stuck at home. And we can see that that's fallen as they've tried to bring those costs back under control. Companies like Amazon are very good lessons in becoming a patient investor. Measuring a company's performance quarter to quarter is usually a very bad idea. Companies of this size can't do very much in a quarter. They take years to implement strategies from beginning to completion. And this is where the long-term investor can do very, very well. If you understand the vision of the business, if that company has built trust and has historically shown that they know where to invest their money, then you know during periods where they are pouring money into the business, there will be an enormous return on that investment, but you potentially are going to have to wait years to see it. Amazon's share price is still a long way from its recent peak, I think 2 years ago. But I believe that this investment that they've made, this multi-year investment that they've made, will mean that they'll continue to dominate the market. And although we should take any forecast with a pinch of salt, we can see that the business has already blown through its historical record in terms of revenue. They've still got some way to go in terms of profitability, but we could see them setting a new profit target as early as next year. All right, so what do we need to look out for this week? Well, there's quite a lot going on in terms of macro activity, but I think that the two most watched topics will be the Federal Reserve's interest rate decision, which we will hear more about on Wednesday, the 1st of November. And also we've got a smattering of labor market numbers coming out. You can see here jolts, unemployment rates, non-farm payrolls, etc. In addition to all of this, there continues to be the wild card of the war between Israel and Palestine. This is a worrying wild card. What's going on in the moment is awful, but there is a chance that this conflict expands and pulls in many other countries. Obviously, we have no control over what happens here, but if you take the approach of buying a combination of bonds and also companies that aren't very expensive, then over the long term, your investments should still be rock solid. All right, that's it for this week. Thank you very much. Speak to you soon.